Hey, Jeremy Portnoff here. With Halloween fast approaching, the season of scary is just about here. And so I was thinking about how scary it can be to pay more in taxes than you should have to. I think this is a challenge that I think most of us can relate to. However, there's a few out there that have had and made such horrifying mistakes with their IRAs and other retirement accounts that they've had to pay so much more in taxes and penalties than they otherwise would have if not for having had made the mistake that it's downright chilling. So, this is going to be the first in a series of spooky stories about spine chilling mistakes people have made with their retirement accounts, and the sometimes questionable attempts to fix what they've done, sometimes successfully, sometimes not so much, and often with head shaking, face palming strategies, and logic that may leave you either terrified or comically amused. The lesson is to work with an educated advisor who can help you avoid these ghastly mistakes. And with that, I give you IRA horror stories. Today, we're going to be talking about taking money out of an IRA sooner than you're supposed to, and some of the pitfalls of doing so. Now, generally, an IRA owner must attain the age of 59 and a half to take money out of their IRA. If a withdrawal is taken before that, typically a 10% early distribution penalty may apply, and that's in addition to any applicable tax that's due on the distribution itself. Now, it's really important to note that it's not the year that one turns 59 and a half either. The IRA owner must actually be 59 and a half. Now, the good news is there's a number of different exceptions to this rule. The exception we're looking at today is known as a series of substantially equal periodic payments, also known as 72T payments, which is after the section of the tax code where it's located. Now, this exception basically states that you can begin a series of these payments before you are 59 and a half and avoid the 10% early distribution penalty. However, the payments must continue for the longer of 5 years or until you reach age 59 and a half. Now, while this may seem simple, there's numerous places where the IRA owners who are tapping their IRAs early can make mistakes. For example, if you modify the schedule, then you can be subject to the penalty, which is retroactively applied to the beginning of the payment period up to 59 and a half. So there isn't really much room for error with these 72T payments. Now, there happen to be a few exceptions to this exception, but we're not going to get into that today. There are a few different methods for calculating the distribution amount, which cannot be increased or decreased other than when exceptions apply, such as a one-time irrevocable switch to what's known as the RMD method, which, again, we're not going to go into details of that at this point. It also means that the account balance cannot be modified either. So, say you've set up one of these 72T schedules and you leave your current job, you decide to roll over your 401k to this IRA. Now, even though you don't change the distribution amount, this is still considered a change in the balance and thus a modification, and boom, you just blew up your 72C schedule, and you can expect that penalty. So, or if your situation changes and you no longer need the money because, tough, you have to continue the schedule. Now, Roth conversions are not allowed on the distributions either since they're not rollover eligible. The balance itself could be converted to a Roth without triggering the penalty. Now, this is one of the exceptions. Death and disability are also exceptions to the early distribution penalty. Now, I get this question actually a lot when discussing inherited IRA. And the beneficiaries often think that they'll have to pay the penalty if they're not yet 59 and a half. However, it has to do with the death of the IRA owner. That's what creates the exception. So one way to create some flexibility in setting up these 72T schedules is to split your IRA and set up the 72T schedule with the least amount of the IRA money necessary to get what you need and leave the other IRA alone so that if you did need extra money, you could take that money from that IRA and not blow up your 72T schedule. Or if you did make a mistake, then the damage is limited to that IRA. Now, these distributions must be at least annually. This means you can do quarterly, monthly, or even weekly if you wanted to. And this is where our first IRA horror story comes in. So it was a landmark 72T case from 1998, and the IRA owner argued unsuccessfully that an extra distribution taken in November of 1993 was permissible because it was taken after age 59 and a half and after he had already taken his fifth annual distribution in January of 1993. Now, why was this a modification? He was over 59 and a half and he had taken 5 annual distributions. Well, it's all in the details. See, he began his 72T payments in December of 1989 at the age of 55, and then received his annual distributions each January from 1990 through 1993. Now, the court ruled that the 5-year tax period ends on the 5th anniversary of the first distribution date. It does not end on the date of the 5th distribution. And there's the rub. Since the first distribution occurred in December of 1989, he would have had to wait until December of 1994 before he could make any changes. And so this really amounted to a timing error on the IRA owner's part. Now, in an IRS private letter ruling, or PLR for short, an IRA owner started a 72T schedule that had to go until at least January 20th of 2005. The last distribution was made properly on October 1st of 2004. Then he separated from his employer in June of 2004, and on October 22nd, 2004, rolled over his company plan balance to his IRA, which he had just completed taking the 72T payments from. But because this was still 3 months before the end of the period, it resulted in a change to the account balance and an impermissible modification that triggered the 10% penalty. Now, the PLR is done when a taxpayer either makes a mistake and is asking IRS if they can fix it, or they're asking IRS's blessing to do something they want to do. Now, these PLRs are not allowed to be used by other taxpayers. However, they can give us an indication of what IRS is likely to say on a similar case. However, beware, because there have been many PLRs where the facts, were very similar, but received different rulings. But I digress. IRS has, on a number of occasions, granted a taxpayer's request for modifications of these 72T schedules for various reasons. For example, IRS permitted a change to a 72T schedule after a divorce. So in a PLR from 2007, the taxpayer began a 72T schedule and then they got divorced. Now, as part of the agreement, he was to give half of his IRA to his ex-spouse. So he submitted a PLR asking if he could make a modification to reduce it, and the IRS allowed it. This has happened in a number of similar PLRs. Now, interestingly, in another PLR, the ex-spouse who received part of the IRA did not have to continue a proportional 72T schedule. Now, this is not explicitly mentioned in a related revenue ruling, even though with a similar set of facts, taxpayer should consider applying for their own PLR, and these can be very expensive. Now, in our next IRA horror story, in a PLR from 2009, taxpayer claimed their financial advisor's error led to a modification of the payments, but the IRS denied the request. IRS ruled that an improper transfer of funds from an IRA where 72T payments were being made triggered the 10% penalty retroactively along with applicable interest. Now, what happened is the taxpayer, we'll call her Sue, she had 2 IRAs, 1 and 2. In 2002, she began taking the 72T payments from IRA number 1. In January of year 1, with the tech wreck in full effect, and sorry for the rhyming, she was concerned that she met with her financial advisor to discuss moving a portion of her IRA investments to cash. The advisor explained that his company offered a cash investment option and that she could make this change without incurring the penalty, but it was not a CD. Now, presumably, she was not comfortable with this, so the subsequent recommendation was for her to move a portion of her IRA to another institution that offered such investments. She took the advice, moved a portion of IRA number 1 along with IRA number 2, which was not subject to a 72T schedule, to a new IRA at a custodian that did offer CDs. And boom, she blew up her 72T schedule. It was a representative from the new custodian that informed her that she made a modification to the 72T schedule. She approached her advisor, who confirmed it was a modification of the schedule and that she was subject to the 10% penalty for the early distributions and interest going all the way back to 2002. Now, in an effort to try to fix the error, she submitted the PLR, and yet, despite the questionable advice from her financial advisor and her foresight to take corrective action, IRS denied her request. Even though Sue didn't get what she wanted, there have been positive results from other cases. In a similar PLR from 2009, IRS said that an inadvertent rollover did not cause a modification. In this case, the IRA owner started her 72T schedule and later rolled over the entire balance to another institution. So far, that's okay. On the advice of her financial advisor, she then made one of the allowed one-time switches to the calculation to lower her payment amount. Still, she's okay at this point. She had 2 retirement accounts from former employers, and she wanted to roll over one to the other. Her advisor properly advised her not to roll over the funds into the IRA with the 72T schedule. However, the advisor's assistant erroneously deposited the rollover check into the 72T IRA. Whoops. The good news is that the IRS ruled that this was not her fault, and she did all she could to make sure the 72T payments continued as scheduled. So, crisis averted. Now, again, these PLRs are very expensive. They can be thousands and thousands, $10,000 plus a professional fee to write the PLR. So it's not a cheap thing and easy to go and do. Now, this could have easily been another IRA horror story, but thankfully it worked out. Another similar case in 2009, the IRS allowed a correction when an error by the financial institution resulted in the full required amount not being taken in 2003. What happened is a new custodian took over, and they erroneously failed to withhold state income taxes, which made the payment less than it should have been. The taxpayer wrote a letter to the custodian about the error, paid the state taxes from another non-IRA account. They asked the IRS if they could make up the shortfall in a later year, and the IRS granted her request on the account that was the custodian's error. Another IRA horror story averted. So there's a number of exceptions to this 10% early distribution penalty. Some of them apply to both IRAs and company employer plans, some to just IRAs and some to just company plans. So it's really critical to understand which because not knowing can really get you and your advisor into some trouble. And this is why it's so important to work with an educated advisor who truly understands the IRA rules. So we'll take a look at more IRA horror stories related to this early distribution penalty a little later. In the meantime, if you have any questions, feel free to reach out. Take care.